These 5 indicators will make you rich. They are not just profitable, but highly profitable. When you trade them the right way, they can be used to trade stocks, Forex, crypto, and in any market where you can use candlesticks to trade. And in this video, I will be showing you how we trade each of these indicators the right way to make massive profits from the market. Now my tribe soldiers, let's get down to business. Apart from being the most popular and the most used indicator, the moving average is a trend indicator, and it works more like a trend line. Let's call it an automatic trend line. The moving average solves 2 major problems for a trader. First, it helps to easily identify the current trend of the market, so you don't need to draw trend lines on the market or look for specific patterns to know that you are in a trend already. The moving average does all that for you. Traders identify the trend by looking at the position of the moving average. If price is moving below the moving average line, we consider the market to be in a downtrend, and if price is moving above the moving average line, we consider the market to be moving in an uptrend. The second thing the moving average does is to help us identify trend reversals. We identify trend reversals when the price makes a good crossover above or below the moving average line. For a single moving average line, or when the prices cross over the moving average line, and at the same time, there is a crossover of 2 or more moving average line. Although this trend reversal is taken more seriously, depending on the length of the moving average. A reversal happening on a 200 moving average line is more relevant than the reversal on a 20 moving average line. The more the length, the more relevant the moving average line. Traders look to get in on trend continuation when price retraces to the moving average line. I will be dropping a link to the full course on each of these indicators in the description box below. And as you watch, you can master them completely. You will find yourself becoming a pro with these indicators. The next indicator is called the Bollinger Bands. The Bollinger Bands are used for analyzing technical statistics and price data in order to get the main direction of the market. They are bands or price channels that represents a range of market volatility. It is made up of a simple moving average line, which is the blue color line at the middle, and an upper and lower band of standard deviation, which is the red and green line respectively. The major purpose of the Bollinger Bands is to show us the areas of low volatility and the areas of high volatility in the market. When the red and green lines are contracting, it shows us that there is low volatility in the market. And when you see the red and green lines widening or getting broad, it reveals to us that there is high volatility in the market. Our goal is to enter when we see those high volatility in the market, as that is when we can make the most profits from the market, and we need to get in early from the beginning, before the lines get too wide or broad, as that will signal a retracement and most time reversals. There are many ways of trading the Bollinger Bands strategy, as you will see in the full course that I will drop in the description box below. One of these strategies is by trading the breakout of the contracting zones in the Bollinger Bands. For example, when the market is trending upwards and the deviation lines begins to contract, normally you will see the prices clinging to the simple moving average line. All you have to do is wait for a breakout of the price to the downside. And as price touches the green deviation line, you find a buying opportunity by waiting for a good entry candlestick to appear. You can do the reverse for a downtrend. The next indicator is called the RSI indicator. The RSI indicator is an abbreviation, which means Relative Strength Index. This is a powerful trading indicator that helps as a confirmation tool for price action strategies and can also be used as a complete trading strategy on its own. It is used to identify strong price movements on the chart through its qualities. It helps to signal overbought and oversold regions on the chart. When the RSI line crosses the overbought region, traders begin to expect the price to start falling from that spot, and we will start looking for selling opportunities. And then, when the RSI lines touches the oversold region, Traders expect the market to start rising from that spot, and we will start to look for buying opportunities. But knowing that these buying and selling signals happen at the overbought and oversold levels is not enough reason to trade the market with the RSI indicator, as sometimes price can hit the oversold region and keep falling, kicking the buyers out of the market. And many times the RSI indicator can hit the overbought level and price will keep rising, disrespecting the RSI and reaping the sellers some bucks out of their trading account. It is best to trade the RSI indicator by understanding the current trend of the market and trading them along with the trend. So your job is to aim to trade the market with the RSI indicator according to the generated signals, which are in line with the current trend of the market. So when the market is in an uptrend, you focus on the signals from the oversold levels. And when the market is in a downtrend, you will only focus on the signals from the overbought levels. The next indicator is called the MACD indicator. MACD is an abbreviation that stands for Moving Average Convergence Divergence. This indicator is one of the easiest of all. This is actually the first indicator that made me profits in my earlier days of trading. The MACD indicator is a trend moving indicator that shows the difference between two moving averages. The MACD indicator is made up of 4 components. We have the 2 moving average line, which are the signal line and the MACD line respectively. We have the histogram, which is the most visible part of the MACD indicator. The first thing that will cross your mind when you think about the MACD indicator works like this. When the MACD line and the signal line cross over below the histogram, you will see the histogram changing to a green color, and when the MACD line and the signal line crosses above the histogram, you will see the histogram moving in a series of red colors. We also have the 4th component of the MACD line, which is called the zero line. You can find this at the middle of the histogram. A signal is generated by the MACD indicator when there is a crossover of the MACD line and the signal line, meaning that if price is going up and you see a crossover at the top of the histogram, it means that price will change direction and start going down. And if price is going down and you see a crossover below the histogram, it signals that price will change directions and start going up. Though that alone does not mean you should click the buy or sell button, and the fact that you saw a crossover will not guarantee a successful trade. This is where many traders get it wrong, and in fact, the MACD indicator cannot be traded alone. The moves of the MACD indicator are justified by applying other indicators to it, and this you will find in the full course, which I will place in the description box below. The next trading indicator is called the stochastic indicator. The stochastic indicator is also a very popular indicator, and more popular among beginner traders. The stochastic indicator is a momentum indicator, and just like the MACD indicator, it has 2 moving average lines called the K percentage and the D percentage. This line also crosses over each other and gives us good signals in the market. But apart from that, the stochastic indicator is majorly known for the signals it provides at the overbought and the oversold levels. So when the market is rising up and the lines crosses the overbought levels, we expect the market to reverse and start falling from that level. And when the market is moving downwards and the lines hit the oversold region, it signals that the market will reverse and start moving upwards. The stochastic indicator and these other indicators works a lot more better under different settings, meaning the stochastic indicator and other indicators will look and give much better signals if they are applied on the chart with some secret settings that gives better results. Many other traders don't know this in the market, and that's why they are losing a lot of money trading indicators. But from today, you won't be like them anymore as you watch this right now and listen to me. My plans for you tribe soldiers are the plans of good and not of losses. I have made a complete full course on each of these trading indicators, and I will drop each of them in the description box below Take them as a gift from the trading chief. In them you will find the settings, the strategies, and in some cases the indicators that I combine together in order to make trades more standard and efficient for you. And if you are confused on which of these indicators you will start from before the others, start from the moving average indicator. Here is the full course to it. And if you want to become my student and learn from me personally, I will leave my contact in the description box below. We are the Trading Tribe. And it's a wrap for this video. See you in the next one.